Good morning, everyone. This is Curtis Hawks over at Insurance Agency Marketing Services, and uh, wish everybody a very happy Friday. Hopefully, it's been a productive week coming off of the holiday. And for you today, we've got a very good topic that we're going to be discussing on how to capitalize on a $35 trillion market when we talk about the generational transfer of wealth that we're going to be seeing here over the next 20 years or so. And we've got some exciting announcements as well. Before we get into that, I did want to talk a little bit about some of the additional ways that IAMS can help add value to your business. Um, and one of those ways is getting additional cash in your pocket and additional resources in your pocket. And so you'll see here, if you're a new producer to IAMS, we've got our new producer bonus. And what you'll see there is there's a variety of ways that we can partner with you. We've got different point levels that coincide with that. Any of your production qualifies, whether it's an index annuity production, single premium life production, which is what we're going to be talking about today, or traditional life insurance. And as you can see there, there's a variety of things available to you, whether it's preset appointments or radio or seminars or even cash or creative design services, but a variety of different things. And so I would encourage you, if you have interest in knowing more about that, reach out and talk to one of the sales directors over here. Our phone number is 800-255-5055, and they can answer any of the questions that you might have on that. And also, if you're doing something marketing wise that's working really well for you, one of the things that you'll find about us is that we're very open to customizing our services. So if you're doing something that's working and you'd like to incorporate that into your new producer builder, then certainly reach out and talk to a sales director over here. In addition to that, we've got our referred producer program. And so for those of you that currently work with us, uh, if you happen to know somebody that is maybe in transition, looking to make a change, or even somebody that you feel like what we do might be a fit for them, send them our way. Not only will you get a $50 bonus when that agent gets contracted, but then as you can see on an ongoing basis, you'll continue to get revenue off of the business they place. You don't have to do anything. We take care of all the service work. But these can be some of the biggest checks that we cut. We had an agent actually here in the last quarter. His check was over $10,000. So it's a great opportunity to generate additional revenue coming into your business without you having to exert any other effort. In addition to that, we've got our marketing reimbursement. As you can see there, for every 100,000 of qualifying index annuity premium, you'll accrue an additional $100 of marketing reimbursement. But on the single premium life side, as well as the traditional life side, you can actually get $200 for every 100,000 of SPL premium, and then $200 for 10,000 of life target. And again, if you have questions on that, reach out, talk to a sales director. The number is 800-255-5055. In addition to that, back office support, which is not a super exciting thing to talk about, but what I would tell you is I think there has been a spotlight put on it over the last couple of years as we've had carriers that have gone remote. And I think most agents have certainly seen turnaround times getting bogged down a little bit. And so I think it's highlighted the importance of having a good team at your IMO working for you. And that's the great thing about us, is that you get to put us on your staff, not your payroll. So whether it's at the beginning of the sales process with quotes and illustrations and sales pieces, to the new business, all the way to the commission process, I would encourage you, if you haven't tested out our back office support, you definitely need to. Technology is a big theme with us. That's one of the things that you'll find if you work with us. And obviously, one of the things that we've seen over the last few years is a significant adoption for e-applications. And so we do integrate with Firelight on our website. You can see here some of the carriers that we work with. In addition to that, we also integrate with iPipeline on the site as well for life insurance business. And the nice thing about it is once you register on our site, you can easily do your e-applications off of our website. You just have to be licensed with us in order to get your login. So if you're not currently contracted with us, reach out, talk to a sales director. They can help you with that, and then we can get you access to the site. In addition to that, we've got our creative marketing solutions team. And I think creative is really the key word there. Uh, we've seen over the last couple of years, agents have tried probably more types of marketing than they ever done in their career, trying to generate that consistent flow of prospects coming in and month out. And I think part of where we're at today, when you think about marketing, is we are in a spot where advisors really have to take a step back and look at their business and what they want it to look like, and how are they currently marketing, and what does that target market look like that they want to get in front of, and put together a cohesive plan to accomplish those objectives. And so 2 points I want to make on this, which is one, our team is very well versed in every best practice you can imagine when it comes to marketing, building your brand, prospecting, all of those items. Secondly, we've actually developed a custom marketing analysis process where we actually will go through and identify what your goals and objectives are. What are your marketing assets now? What does your business look like now? What is the target market that you want to go after? And put together a formalized plan for you. And so if you haven't taken advantage of that, it's completely complimentary. Reach out, talk to one of the sales directors over here, and they can get that scheduled for you. And right now is a great time to do that. We're coming up on the halfway point of the year. And so this is a great time to take a step back and spend a little bit of time working on your business and look at how's the first half of the year, what do I need the second half of the year to look like based off of the goals that I set going into the year. In addition to that, we've got our IMS website. Wealth of resources on here. I'd mentioned that we've got our e-app platforms on the website. We've also got a myriad of sales tools and ideas and pieces on there. You can run life quotes, you can run annuity quotes. We've got our sales resource library on there, which is literally hundreds of downloadable, customizable point of sale pieces that you can use live or in a virtual setting on every topic you can imagine, whether it's how does an annuity work or how does life insurance work, all the way to trust documents and premium finance and every complex topic you could think of. And you can get access to all of that through the click of a button on the site. You just need to be contracted with us. Illustration software. So we're all familiar with illustrations, whether it's on the annuity side or the life insurance side. But oftentimes, especially in a virtual setting, part of what we've got to articulate is what's the rest of the story and how does this product solve or provide the solution to the challenge that you had. And one of the biggest fears for people out there is, am I going to outlive my money in retirement? And Retirement Analyzer software does an effective job of showing somebody, okay, if you keep doing what you're doing now based off of what you want retirement to look like, here's how long your income is going to run for. And then be able to go back to them, and if it's not going to run out as long as they thought it was going to, then have the ability to say, okay, well, when would you rather know that, now or when it's too late to do anything about it? And then you can show them how you can position annuities, life insurance, et cetera, to address that income gap and that shortfall. And the great thing about it is you can get access to it absolutely for free through IMS. And we integrate with a number of other software platforms as well. We also integrate with Stonewood on the cash value life insurance side, which again, you can get access to absolutely for free through IMS. So just reach out and talk to a sales director and they can help you out with that. IMS Wealth Management. So we've seen significant growth with our RIA platform. This started a few years ago, but now is a great time to be getting into this marketplace. I mean, we've seen what's going on in the market. And I think a lot of advisors, what they recognize is that there has been an ongoing shift in the marketplace to do more comprehensive planning. And so the team over there does an amazing job. Right now is a great time. Whether you're currently an IAR and you're not happy where you're at, or whether you've been thinking about adding this component to your business, give Duncan and the team a call over there. They'll be more than happy to walk you through what they do, how they add value for an advisor, and how they can really make a positive impact in your business. Life and Annuity Academy. So these are back. We had a little bit of a hiatus during COVID with these, but we do have these back up and running. In fact, we did our first one back in September of last year from taking that break. We've actually got another one coming up here in 2 weeks that we're doing in partnership with Athene. And we've also got academies lined up for the second half of this year as well. But this is an amazing opportunity. I mentioned working in your business versus working on your business. Throughout the majority of the year, all of you spend your time working in the business, prospecting, marketing, working with clients, dealing with the IMOs, the carriers, etc. But one of the things I think we all recognize is that while that is necessary, I mean, that's how you generate your revenue, equally important is spending some time working on your business, taking a step out of the day-to-day minutia and really looking at, what do I want my business to look like? What do I want it to grow to? And then what's out there? What are the resources that I need to incorporate into my practice in order to accomplish my objectives? And that's specifically why we designed the Life in the Annuity Academy. Not only do you get a good sense of what are the cutting edge marketing prospecting systems that are out there, you get to hear from other top producers talking about best practices in their business and how that impacts them, as well as learning more about what are the software platforms that are out there, what are the top sales strategies, what are the top products, etc. So it's a great opportunity to really hone in on your skill set, identify what's out there that can make a positive impact in your business. And I think there's a lot to be said about the meeting, outside of the meeting, which is being able to interact with your peers and talk to them about what's going on in their local market and what they're doing in their business. And so these fill up very fast. I mean, we've had a backlog of interest in that since we had to postpone some of our events during COVID. So what I would encourage you is, we do have this event coming up in a couple of weeks. We do have events scheduled for the second half of the year, but if this is something that you're interested in, you need to reach out and talk to a sales director and get your name on the list because they do fill up fast. In addition to that, did want to mention our Top Producer Summit. It's going to be at the Greenbrier. And it's really, when we put these on, we want to, it's all designed to facilitate relationship, get you around your peers, and really reward all the hard work that you put in, day out. And so we've got a great event coming up here in October, and still time to qualify. So for those of you that are on the edge of qualifying, there's still some time here to get some more business paid. And then for those of you that have already qualified, you can see here that we've got multiple tiers for what you can qualify for. I would also encourage you as well, if you want to know what your current rankings are, go to the IAMS website and get logged in. We've got a kind of like a stock ticker on there, but it shows where everybody's ranking is for the event. Great way to see where you stand and what you need to do to make sure that you qualify and get in. And if you've got additional questions on it, reach out, talk to a sales director over here. They'll be more than happy to chat with you. Lastly, we do a significant amount of posting on social media on both Facebook and LinkedIn. This is a great way to get additional information on the services, products, marketing strategies, et cetera, that we do. It's also a great way to hear about other advisors and what they're doing. We've got our IAMS Innovates series that we post, which is all oriented around what are challenges that agents are facing, and then what was a goal that they had, and then what were we able to bring to the table, whether it's marketing, case design, et cetera, to provide that solution. So I would encourage you, if you're not following us on LinkedIn or Facebook, you definitely need to, because it's another great way to see what we're all about and how we can help affect your business. So with that, what I'm going to do is I'm going to go ahead and get this switched over here. So we've got Doug Murphy with Baltimore Life on the call with us today, and he's taking some time out to talk about the significant opportunity that exists in the SPL space.
Curtis, can you hear me well? See my screen?
Yes, I can.
Yes, I can. All right, thanks. Again, thanks. I thank everyone on the call for taking time out of your day to, especially a Friday, to listen to what I've got to say. And I want to say a special thanks to IAMS, Curtis, Sandy Albers, who I do a lot of business and talk to on fairly often occasion. But you get a chance as a company our size, and we're relatively small to a small mid-sized company. that we get choose who we get to do business with. We don't go out and try to do as much business as some of these companies like to do. We're a relatively small company. We have to watch our surplus strain and that kind of thing. But with that said, you get to choose your partners, and IMS has been a great partner for us for probably 10 years or so, and have written a lot of single premium business with us as well too. And we value that relationship. I'm the only one that travels with the company that from a business standpoint, and I have all the relationships. There's no regionals that report to me. So I get to have those relationships, and you can only maintain so many. And we think that IMS is probably one of the top marketing organizations that we do business with. I mean, you got Curtis spent about 15 minutes there going through all of the things that they provide for you. And I would tell you, those are great incentives that I can't think of any other place you're going to get those. I go out to all the carrier websites that we do business against and IMOs that we do business for and with. And they probably have, without a doubt, the best agent website that I see. And I think that was demonstrated there in all the stuff that Curtis just went through. And I appreciate all the things they do for us and the partnership that they have with us and the support they've given us. And hopefully we've returned that. So with that said, I'd like to get started. I'm not going to take up, I promise to be finished before the hour and maybe a long time before that. Curtis, I'll kind of leave it open to you how you want to handle questions and that kind of thing. If you want people to ask them as they go along, or if they want to wait till the end or submit them on through the chat or something else. But again, my name is Doug Murphy. I'm Vice President of National Accounts at Baltimore Life. I'm going to talk to you today about what we call asset transfer for the middle market. It's not asset transfer or wealth transfer for the wealthy, the super wealthy, that kind of thing. We're talking about a simplified issue life products. We're going to talk about two particular products today, and we're not going to get so much into product as we are into sales ideas, where to find these clients, how to identify them, how the product would fit, where they fit and where they don't fit. And the main thing I always like to highlight is how we're going to help you grow your business. I'm not here to try to take business from another carrier that you may be doing this line of business with. I'm trying to think of ways that can help you grow in a market or in a product line that you may not have had access to or didn't really understand or think much about prior to this webinar. So I really want to help you grow your business and not take it away from another carrier. That's not our intent. That doesn't help IMS, and it doesn't help you. The only person that would benefit from that is us, and I always like it if everybody benefits across the board. The first thing I want to do is, and some of you, I don't know the experience level of the agents here. I go through a lot of this just to kind of set the stage for the presentation, but we're talking about middle income market clients here. We're talking about people that's got money set aside that they're not using to live off of. Sometimes that can be as little as $5,000. Some of it can be several $100,000, and how much they've got set aside, whether it's a lot or not much, varies from person to person, as you guys well know. So, most of these clients, they want to live comfortably in retirement. They don't want to be well off. They just want to live comfortably. They want to maintain good health. The happiness and welfare of their children and grandchildren are important to them. They do want to leave assets to their heirs, but they need guidance from an agent. They need somebody that understands their clients' needs. Most of you have clients out there that are you're already their annuity producer or work with them on the life insurance side in some capacity. You want to be able to help them arrive at solutions. And I put there the third bullet point: clients should understand that solution within 5 minutes. And the time frame is not as important as it is that what I'm trying to point out is this: it has to be a simple solution that a client fully understands. We're not talking about, these products that we're going to talk about today have a whole life chassis built into them. They're not universal life. They don't have you don't have to worry about explaining the Hang Seng index or the S&P index or the different crediting strategies and that kind of thing. So client really needs to understand these solutions and for you to be able to make them kind of grasp these concepts within a relatively short period of time. When we think about the senior client, which is predominantly where these funds are going to come from, client looks at whether they have communicated it to you orally in writing or just in their own mind, they've kind of got it set aside. Is they look at three sources of retirement planning funds and the retirement planning process. And I've kind of got it highlighted here into what I would call mason jar type things. But even in a client's mind, where they've communicated this to you or not, they kind of break their retirement down into having retirement funds, funds to live off of, funds that they're going to supplement with Social Security and other funds that they may have. Contingency funds, this is money I would call the what if money. It's money set aside. They don't plan to use it to retire off of, but they've got it there in case they've got some type of medical emergency, some type of long-term care need perhaps, or maybe they need a new roof on their house, or a major car repair or something else. It's what I would refer to as what if money. What if I need it for this, or what if I need it for that? And then they want to leave a legacy funds that are out there that's supplied by life insurance. I realize that this can be done through trusts, but most middle market clients don't want to undergo that effort, and they don't want to give up control of their assets. In a lot of cases, they would have to do that. So think about those different baskets or jars or whatever, those different how a senior client segments that. And we're talking clients that in their 60s, 70s, maybe into their early 80s, and how they, most of these clients don't pay for vacations by credit. They've prepaid them or saved for them, and then they take them. And that they kind of segment their own funds. They're probably the type of person that's got, already got a cemetery plot, and maybe the headstone's picked out at the cemetery in preparation of their death, so their families don't have to do that. That's the kind of planning these seniors do, and that's the kind of thinking that they utilize around their retirement planning process. For retirement funds, Climate breaks down retirement funds into what they expect to receive from the Social Security benefit, pension plans, and that's what we would find as defined benefit pension plans, distributions from 401ks, IRAs, et cetera, and that kind of thing. According to a 2017 American College study, American College does a lot of work on the insurance side. They're the one that provides the CLU designation, the CHSC designation, and the CFP designation now. The study done back in 2017 said people between the ages of 65 and 70, 75% of those people had a defined benefit retirement plan. I'm 60, I have a defined benefit retirement plan. It went out, the company quit providing that in the late 90s, and then from that standpoint on, they started providing a 401k plan. It was a previous company, previous insurance company, but most companies now don't offer a defined benefit pension plan, which is the second dot point up there. They do offer 401ks and that kind of thing, but a defined benefit pension plan, if you're relatively young in the insurance industry, you may not even realize what that is or how that works. But defined benefit means a company set aside money for you, and their job is to say they're going to based off your retirement age and how long years of service and your income, what kind of retirement benefit you'll get, and it's a guaranteed amount out there, and then they've got to invest in the things that they can invest in to supply that pension at the time that you retire. Obviously, those things were burdensome to the companies, and it's the reason companies in the late 90s typically got away from. There's some that's still out there, but not a lot. Most people now rely on their 401ks, and the 401ks become IRAs and that kind of thing. But keep that in mind that 75% of these people have a defined benefit pension plan. Retiring baby boomers, these are people that are in the process of retiring or haven't retired yet. Retiring baby boomers have a median savings of $147,000 in all of their household retirement accounts. Now that obviously doesn't sound like a lot. It's actually, as you see there, it's up from $99,000 in 2012. Obviously, this slide was put together a little while ago, probably prior to the decline of the market going down recently, but it's still relatively true that the idea being there that $147,000, especially if we're talking about passing assets on to next generations and things, that's not a lot of money when you think about it. $147,000 to live off of, even though that's up considerably from 2012. 22% of baby boomer workers, these are people that are still working. 22% of that group have less than $55,000 saved. However, only half of that group, half of that 22%, 51% actually, are very concerned about outliving their savings in retirement. You think, well, how could that be? How could 22% of people have less than $55,000 saved and not be worried about not very concerned about outliving their savings in retirement? And it goes back to the previous screen. If you think back that I said that most people have, 75% of that group have a defined benefit pension plan. All of them that's retired and above the age of 65 have Social Security benefits, or should have some type of governmental benefit that's similar to Social Security. But you're going to have a Social Security benefit along with their defined benefit pension, and that's predominantly what they're living off of. My parents are a great example of that. My dad worked and had a defined benefit pension plan for years. Toward the end of the stage of his work career, they went to the 401ks. He still has his 401k and an IRA now, but he still has that money set aside as what he would call his what if money. But he and my mom are living off their Social Security benefits and the defined benefit pension plan money that they had at the same time. So it's one of those things where even though they don't have a lot to show out there and assets saved, they're living off of that Social Security and defined benefit. So I think that's what you've got to be cognizant of and think about whenever you're talking to these clients that don't seem to have a lot of money, how they're living, how they're living in their retirement and not utilizing those funds, and what's the purpose of those funds that they do have set aside for like their what we call their what if funds. Contingency funds, these are assets that clients don't expect to use in their retirement. They're saying, hey, I don't think I'll need it right now. I don't need to have it. You never know what the future is going to hold. But these are funds set aside for like an unexpected financial crisis or medical need, maybe underperforming retirement funds, or maybe outliving those retirement funds. And obviously, life insurance can be an opportunity for your client to increase the value of these funds. But it's primarily, as I said, it's what if money. I've got that set aside. It's just for in case I need it for an unexpected need or emergency that may come up. And then obviously the third fund, I'm not going to spend much time on it. We're going to talk about the life insurance funds or the legacy funds, the funds they want to leave behind to their heirs, and what's the best way of utilizing that concept. We're going to talk. I'm only going to say one or two slides on product. But this is to me, and the sales directors at IAMS or Curtis or Sandy or someone can get this information to you. This is actually a one-page flyer that they can email out to you. If they don't have it, Curtis, you guys can get it from me, and I can get it to you to send out to the people that are interested. But this is a good one-pager that kind of breaks down the two different products that we utilize for asset transfer for the middle market. The first one there on the left-hand side you see is our single premium whole life, and that is simply it's a large sum of money or sum of money set aside. One single premium buys an immediate tax-free death benefit. The other product that we have is relatively new. It's relatively what I would call a unique product within the industry. There's some carriers that tried to mimic it. Nobody's done it exactly, and I think utilizing our concept, you'll see that it's a much better way of structuring a concept to get what the idea behind generation legacies. The most tax efficient way to get money out of qualified funds and non-qualified annuities and move it tax efficiently into life insurance. We all know that you can't 1035 cash value out of annuities or IRAs into life insurance, although you can do that from life insurance into annuities. You can't do that from annuities into life insurance, but we've got a way, and I'm going to show you how the best way to do that tax efficiently, and based off the client's other income may not require them to pay any income tax at all, but it's really designed to make sure that it's moved tax efficiently. The biggest differentiator there is, say, which product would I use? Would it be the SPWL or the generation legacy? Is the source of the funds. If the source of the funds is after-tax cash money, CD money, money market money, or 1035 money from other life insurance policies, then probably the best vehicle there is going to be the single premium whole life. If the money it's got qualified funds in it, whether it's a non-qualified annuity or IRA or some other type of qualified plan, the concept there is the best products are going to be the generation legacy. Now you're going to see down below that there's going to be a number of differences in these products. Every one of these differences has a reason behind it. If we had a lot more time, I could go through and explain the differences. If I do have time, I'll try to explain those. But the first one is age 50 to 85 for the single premium whole life. Generation legacy goes from 60 to 80. The reason that we don't go down to 50 on the generation legacy is because one of the funds, you're using qualified funds here, which is really you're taking money that's been set aside theoretically for people to retire off of. We don't think you can ask somebody much below the age of 60 whether they're going to need those funds to retire off of and then be able to answer it appropriately or not until they reach about the age of 60. On the upper side of that, the reason we don't go to age 85 on our generation legacy is, as you'll see in a few minutes, the concept would take that issue age and the way the policy is structured out beyond their current life expectancy. So our reinsurers and the various departments of insurance would not allow us to go past age 80 on the maximum issue age on that. Underwriting classes with their generation legacy, we actually have two levels. Level 1 being standard to table 4 underwriting, level 2 being tables 5 through 8. And all that is let's say you had a client who's got $50,000. If they're level 1, it might buy $78,000, $79,000 of death benefit tax-free. based off of their age. Level 2, the same $50,000 premium, might buy 74, 73, 74, 75 based off their age. So it's going to buy a less face amount, but obviously the same premium. Generation Legacy's only got the standard through table 4 concept. Both of these products have what we call point of sale underwriting decision. Right now, what they'll allow me to put on this screen is over 90% point of sale decision that policies that we take. Actually, it's right around a little above 92%. I think it's 92.3% of the cases go in or approved right over the phone. You're going to go into the client's house, take the application, pick up the phone call. It's about a 9 or 10 minute phone call. You're going to get a point of sale decision right over the phone before you leave the client's house. The underwriter will provide you with the number that you're going to write on the top of that application. Submit it with it. All of the underwriting is done. We do no more underwriting when we get it in house. It's all done there before you leave the premises and then in the client's house. So the idea of being there, I spent 20 some years as an agent. I don't want you trying to promote Baltimore Life and sell Baltimore Life products and then spend all that time, come in, and then we submit it to us, and then a couple of weeks later or a week later, we tell you that based off of their underwriting that we can't take it, and then you've got to try to get back in front of that client on a favorable basis. We prefer to tell you that as quickly as we can while you're there with the client. And for some reason, we can't take the case based off the underwriting. You're still there with them in a favorable basis and can write them something else, maybe another life insurance product that they can qualify for, or an annuity that you may be there talking about to start with. Minimum premium, both of them have a minimum premium of $5,000 on a single basis. They both offer, and you see these next documents, partial withdrawal options, loan options, and accelerated death benefit. I kind of lump those together. That's what's going to provide money for that contingency fund type thing. The client says, hey, I've got money set aside for a long-term care need, or I got money set aside for a home repair, or money set aside for medical needs in case I have them, or a long-term care type needs, something like that. These funds are to help provide that. Obviously, they pay a little differently, and you can see there, and I'm not going to get into them specifically, but they both provide partial withdrawals from the life insurance policy. They both have loans available. The loan availability there says maximum rate at 8%. I think we're somewhere around 6% now. I think that's where we're at. And they have accelerated death benefit. And I've alluded to in here that client may want this for long-term care coverage. This is not long-term care benefit. This is an acceleration of the death benefit. If it was long-term care and you defined it as long-term care, then we would have to file the product in this rider as a health rider. It's designed basically as an acceleration of the death benefit. So if when you're filling out an application and you put down on the form what's the purpose of the funds, don't put down the client likes the long-term care benefits. That's going to cause us problems because we have to show those to the states in the event of an audit. Put down that the client needs a life insurance plus they like the accelerated death benefit riders and that kind of thing. But I just tell you that just to kind of keep you from having a headache if you were to say something about long-term care. It's really not long-term care. We're not going to pay them on a monthly basis. We're going to pay them a one-time payment based off of the face amount of the policy. And again, this is based off the face amount of the policy, not of the premium they paid us. So in the event on the single premium there, we're going to pay 95% of the face amount for terminal illness. Nursing homes 90%, extended care, home health care, and adult daycare are 80%. On the Generation Legacy side, because of the way we structure it, and hopefully I'll get a chance to get into that a little bit later, terminal illness is at 75%, nursing home is at 50%, and extended care is at and home health care and adult daycare is at 50%. Hopefully, in a second, I'll be able to come back and explain to you why those differences are. One of the big differences is it's a loan. It's a loan against the policy under the Generation Legacy. Once you access the accelerated death benefit, if you do it the full amount on the single premium for the full amount, then that policy, the rest of the benefit goes away. But when I get into the illustration in a second, I'll show you why the Generation Legacy is at a lesser amount and how it's actually not really a less amount. It's just the way that we structure the contract and the policy that it actually just pays differently. The maximum face amount for single premium whole life for level 1, 50 to 80 there, you can see is $250,000 net amount at risk, and 81 to 85 is 150, and then level 2 drops down. For this product, the net amount at risk is the difference between the premium the client pays and the death benefit. So let's say you have a client that's, and I'm just going to shoot it off the top of my head, just don't hold me to this number, but let's say you get a client that gives you $200,000 of premium, single premium, but the the death benefit based off the client's age, the illustration would come out to $475,000. The most we would take is the $250,000 net amount at risk, the premium, the face amount over the premium. So our illustration would limit it to say you can only give us, if you want to give us $250,000 of premium, based on you're only going to be able to give us 230, and then that would generate a death benefit of 480,000. So we'll help, the illustration software will help make sure that you stay within those guidelines, simply because these are simplified issue products. We're not going to go to the large $1 million, $2 million, $10 million type face amounts. This is completely simplified issue. And that's the reason we limit what we call the net amount at risk for these. You see there level 2 is a lesser amount. For the generation legacy, the maximum we'll take on that is a $450,000, whatever it takes to fund $450,000 of whole life policy. So in a second, you're going to see that this involves generation legacy. Actually, when you deliver the policy and take the application list, you're going to deliver 2 policies. You're going to deliver a single premium immediate annuity, and you're going to deliver either a 7-pay whole life policy or a 10-pay whole life policy. And that policy will be based off of the client's issue age. If the client is ages 60 to 74, it's a 10-pay policy. If the client's 75 to 80, it will be a 7-pay whole life policy. And that, the only way you can differentiate there is what the client's age is. You can't pick and choose that. It will be based off the client's age. And then the death benefit for the single premium whole life is actually the death benefit for the product. That death benefit doesn't go down. It will remain the same for the rest of the client's life. For the death benefit on the generation legacy would be a combination of the face amount of the whole life policy and whatever may be remaining in the payments from the SPIA. Again, I've covered a lot of information there. I can get this out to the group at IAMS if they don't have it. I think they have it, but if they don't, I can get it out to them. If you would like it, you can request that. Probably the easiest thing to do is request that through them. Here's a really good illustration I like to use. I think I like it's because I'm not trying to be pie in the sky. I'm not trying to give you anything else that shows you is trying to make sure that you guys can see the full slide here. Yeah, here we go. So it's female, age 70, typical client of yours. She's non-tobacco. She's got a $50,000 annuity. She got a $50,000 annuity with a cost basis of 40. And those of you who don't work in the annuity environment, cost basis is simply what she paid for it. Some time ago, she put $40,000 into annuity. It's now grown to 50. If you as the agent went out to her today and was going through what the purpose of the funds was, and she said, well, hey, Curtis, I've got this money set aside. I don't need it to retire off of. I'm not planning to use it to retire off of. I've simply got it there, in case I need it, just for medical purposes, or in case I have to go into a nursing home or something, or in case I just got it sitting there just in case I need it. But if I die and it's still out there, I'm just going to leave it to my kids or my grandkids or church or charity, whatever the beneficiary is. That's a perfect client. This is not some type of pie in the sky. So based off of that $50,000, you could say to her, okay, well, let's take that annuity and let's cash it in and let's use what's left of it to buy life insurance on a single premium basis. And you can do that. But she's going to pay, she's probably got other income. She's probably going to pay tax on that $10,000 all at one time. So it's going to, just in this example with no other income, she's probably going to pay about $3,000 in tax on that, let's say, $2,000 to $3,000 of tax. So that's going to leave her, instead of with $50,000 to buy life insurance, it's going to leave her with 47 or 48. What we're trying to do is, utilizing this concept, is to minimize the amount of tax that she may pay and minimize the amount of tax and make it tax efficient for her. So what we would propose to do in that case would be to keep the same $50,000 in the annuity and do a 1035 exchange from that annuity that she's got into our generation legacy SPIA. Remember the previous slide, I said you're going to have 2 policies, a SPIA and a life insurance policy, either 7-pay or a 10-pay. So we're going to be able to 1035 exchange that $50,000 annuity, the full value, over to our generation legacy. And you see there under single premium in year 1, we make that connection. So now she no longer has her old annuity. She now has a SPIA with Baltimore Life for $50,000. At the same time, we're going to issue a 10-pay in her case based off the age of 70. We're going to issue her 10-pay life policy at the same time. the first thing we're going to do after we got that premium in the annuity is we're going to take a SPIA payout there of $5,570, which is liquidating 1/10 of the premium plus the interest that it would earn. So we're going to take $5,570 and we're going to say over to the right-hand side, that buys on a 10-pay basis $78,451 of tax-free death benefit. That's a tax-free death benefit that will remain the same as long as the policy stays in force and the client's alive. And then it pays it on her death in this example. Based off of the exclusion ratio, in our software say, okay, well, she's got $50,000 annuity, she put $40,000 in it, the exclusion ratio there is 71.8%. We're going to exclude 71.8% of the premium, the $5,570. So we're going to exclude right at $4,000, $3,999 and change, which leaves her with an estimated taxable amount of $1,570. She will get a 1099 for the next 10 years, or 9 years, and in the 10th year, you see there, it's just slightly $7 short, but $7 smaller, but she's going to get a 1099 for $1,570. The idea being there, she's not paying tax on the full 50 up front. She's only going to pay tax on that 1,570 in addition to her other income. If she doesn't have a lot of other income, she may not pay tax on this 1,570 at all. But it typically, in most cases, very seldom would ever throw into a higher tax bracket. But it's going to be, she's only going to pay tax on that $1,570.74 every year for the next 10 years. So that would leave her at the end of after the first payment's made, of $41,250 in the SPIA. And you can see how that SPIA benefit decreases down there to where we're liquidating that SPIA. So you made a one-time single premium payment every year for 10 years in this example. We're going to take $5,570 out of the SPIA until it's completely liquidated in 10 years. You see the exclusion amount, the estimated taxable amount that she'll get a 1099 on, and then the whole life death benefit will remain the same. If that client died, let's say in the third year, the beneficiary will receive $78,451 of tax-free death benefit. At that time, they will still have the ability as a beneficiary to either take the commuted lump sum that you see there of $33,850, or they can continue to receive that $5,570 every year until the rest of the policy is paid out for the next 7 years. So whenever that's done, whatever's left as residual in the SPIA would be paid out to the beneficiary as well. Now that would be taxable. That portion would be taxable to the beneficiary, but the whole life death benefit would be tax-free. So in the third year, you're looking at $78,451 non-taxed, $33,850 commuted. That would be taxed for a total death benefit about $112,000 or so, I think it is. So that's a great illustration to me that points out the concept behind this. You could take that and say, okay, what if it was a female age 70 non-tobacco, $50,000, and it's an IRA? So we can look at the other end of this. So there would be no cost basis. Everything in there was before tax money. So the exclusion ratio would be 0. You see there. So how that illustration would look then would be, okay, you got the single premium of $50,000. The SPIA payout would still be $5,570. There would be no excluded amount if it's an IRA. The estimated taxable amount every year would be $5,570. But again, would she rather pay tax on $5,570 every year in addition to her other income, or would she rather pay tax on $50,000 early on, at the beginning before she moved it over, and then utilize what was left to buy life insurance? She would buy a whole lot less death benefit tax-free, and then she wouldn't really benefit from the spreading the taxes out over 10 years by utilizing that concept. So what we were doing here is doing that estimated taxable income of $5,570 every year. The SPIA payout would be exactly the same, and the whole life death benefit would be exactly the same. So I kind of gave you two different options there, one with a small cost basis, the other one with no cost basis, and it being an IRA. So hopefully that gives you a good idea how that illustration would look when you comes out to a client. Here's an idea, and I'm going to start to get into some sales ideas for you in my last few minutes. This is relatively new concept. We call it the spouse option, and it has to be right now. We only take it on a spouse, and the reason for that is that they typically file income tax together. So the idea behind this, when you're filling out the Generation Legacy app, they're gonna have an application for the annuity, and then you're gonna have an application for the life insurance policy. A lot of cases, if the client is obviously the same person, it's going to be the same person, the same information to be on both applications. But they're an attached application. But let's say that you got a client that's got, let's say that same lady a while ago has $50,000 in that annuity, but she's uninsurable. She's completely uninsurable health-wise. But her husband is insurable. So in this case, we could write the annuity and make the spouse, the lady in that example, the annuitant, and the annuity, the SPIA annuity would be in her name, and the life insurance policy would be in the husband's name. Obviously, it would be vice versa if it was the other way around. But the example I just gave, that's the way. Let's look at it that way. They can take that, and then the SPIA payout of her annuity would be used to pay the 10-pay policy or the 7-pay, whichever one it was, based off of their age, to fund the life insurance product. So they're accomplishing the same thing, to pass on money to a second generation, or a church or charity or something else. So it's really, I would encourage you to think of the clients that you have that have money set aside, that feel like they need more insurance, that can't really pass it on because they don't, their health wouldn't allow them to do that. Think of the clients that you have out there now that they're in that kind of classification. If you have some of those, call the sales directors and the people at IAMS, and they can help walk you through these options and how to propose these and present this to a client, and whether or not it works for the client and that kind of thing. But I think it's a great option. It's going to also, as you're coming up on clients in the future, clients you're going to be working with next week, the month after, whenever that may be, every time you come up with a client with a health issue like that, and they've got some funds that they theoretically or might want to pass on to future generations, think of this generation's product and the spouse option that's available out there on that. Again, the 90% point of sale decision is actually higher than that now, but that's what our compliance department lets me put out on presentations and stuff like that. We want to make sure that you don't lose a sale because you're presenting Baltimore Life there. And I know if a lot of you work primarily in the annuity space, one of the worst things about working with life insurance that you feel like is, you have to deal with the underwriting. We want to try to take that pain away from you. If the client's truly in need of life insurance and want to use those funds to pass on, we don't want you being held up and in your mind saying, well, I don't want to go through the underwriting the process of that and deal with that. So we're trying to take that as much off of you and the concern away from you as possible. Now, the last slide I'm going to show here of any significance is, where do you find these clients? And these are things that we pick up from other agents, other marketing organizations, and things like that. Always get in the habit of asking, what's the purpose of the funds? Annuities not needed for daily living. Somebody might say to me, Doug, if you were to say, what's one typical client that you could say is a deal client for these products, especially the generational legacy? I would tell you that it's used to be a client that was 70 and a half, and now they're 72, 73 years of age. And why is that? Because these are the clients that are now being required to take RMDs. A client's telling you when they're taking an RMD, and all your clients that have RMDs, this is a great concept to at least talk to them about, is they're telling you that, hey, I retired some time ago. I'm now over the age of 72. I've got money set aside that I've not used since I retired, and that was probably 65 years of age or somewhere in that range, maybe a little younger, maybe a little older. I've lived this long without using them to live off of now. They're kind of sitting out there as what if money. I'm going to leave it for my heirs if I die with it. That's what it's for. And that's a great client to at least have this conversation with. Not to say that this is the best or the only product for them, but I think that's at least a conversation you owe it to yourself and you owe it to them to have with them. But what's the purpose of the funds? If they say, hey, I'm 73 and I think I'll need those funds, I'm laddering them, I'll need them at age 75 to live off of. Our products are not the product to be putting that type of funds into. But if they say, hey, I don't expect to need them to live off of, I might need them in an emergency. Obviously, our loans, our ADBRs, and our the partial withdrawals and stuff would provide them money to have for daily living expenses. I always like to give a client something to have a conversation piece about. Ask a client, no matter what, every client that you're dealing with, ask what they got leave behind money. Now, obviously, hopefully going through this presentation, you kind of get an idea what I'm talking about, but a client won't have. So if I was to ask Curtis, Curtis, do you have any leave behind money? Curtis's response is probably going to be, well, what do you mean? And I'm going to say, well, client, Curtis, if you've got money set aside, any amount of money set aside, it's either leave behind money, money you don't anticipate to live off of, and you're just going to leave it behind, or it's live on money. It's money you anticipate having to have, need to live off of, and that money is your annuity money or something else. But get in that habit of asking them if they've got leave behind money. It's at least a conversation starter. Their response to that may be, I don't have much, I've only got a little, $5,000. They may say, I don't have much, I've only got $250,000. So it's always just a good conversation starter. 1035 exchanges of an older paid up policy. A lot of these clients have, my grandfather, years and years ago, back before I joined Baltimore Life, I was responsible for going through all of his insurance papers when he passed away. And typically he had them in a shoebox, and he had some $250 face amount policies. These goes back into the 30s and 40s when those were fairly significant or fairly good sized policies. I'm talking about a $250 face amount. And he may have, I think he had 8 or 10 of those. When he got married, he bought a $1,500 face amount policy in the 40s. And you can see where I'm going with that. But in all told, he had about 17 policies, all paid up, all whole life type policies, 20 pay, 10 pay type policies with about $14,000 in cash flow. Not a lot, but the idea being, if you've got people like that that's in relatively good health that can qualify for life insurance, is 1035 exchange those all into, based off of the new commissioner mortality tables, you can probably take that $14,000 and buy a lot more than $17,000 of death benefit, according to their age, obviously, but at least it's something worth considering for that client. So you're taking paid up policies, putting it into a single premium paid up policy, and increasing the death benefit in most cases. It wouldn't be worth it if you weren't increasing the death benefit, obviously, but I think based off the new and the commissioner mortality tables and things, cost of insurance has gotten smaller as we've gotten less as we've gotten further along in years. But next concept is universal life rescue. I started in the insurance business August 27th, 1984. I used to be the youngest in my office. Now I'm one of the oldest. But back then we sold a lot of universal life. Probably 90% or greater of the business we wrote back then was universal life. It was sold in an interest rate environment of 13, 14%. In some cases, if you were Kentucky Central, some other companies, you sold 15%. And that's because that was the interest rate environment that we were in. We watched cash values jump drastically during that period of time throughout the rest of the 80s, even into the 90s. Even whether or not you sell universal life or not, always get in the habit of asking your clients if they've got universal life policy. They at least, most of them will know what it is because they get an annual statement every year. It's usually a 1 or 2 page document that's on one side, it's got a letter thanking them for their business. On the other side, it's a ledger telling them what they start with cash value. At the end of the year, it tells them what it ends with. And it's kind of a ledger back and forth, how much premium they paid, how much insurance benefit came out, how much, everything, all the pluses and the minuses of the policy each year. And it shows them what they, you can look at that and say, okay, well, you started last year, Curtis, with $36,300 of cash value. Now a year later, you just got your annual statement and it's $31,200. So we've dropped over $5,000 in 1 year in cash value. You can expect that to drop that fast or a little faster in the next few years. So probably in about 5 or 6 years, your life insurance will go away. And typically in this case, most of these clients are paying a fairly hefty premium too. They may be paying $300, $400, $500 a month in premium or more. So the idea being there is that you could take that policy, what I would call a rescue. You could 1035 exchange that cash value of that universal life. Keep in mind and make sure the client understands you're probably not going to be able to meet the death benefit of that universal life policy because it was written years and years and years ago. But at least this policy's cash value will now start to go back up. Their death benefit will remain the same until their death. They won't have to worry about losing it in 5 or 6 years or whatever that time frame is. And it gives them peace of mind of having life insurance that's not going to go away. And I think that's a concept you've got to at least talk to clients about. Burial account, I'll mention that briefly, whether you've worked in final expense or something else I mentioned early on about clients in this age group pre-plan stuff. I took one of the first policies that we wrote as a company was on my parents. My mom had a $10,000 CD she said it had set aside to pay her final expenses, and my dad had a $10,000 CD set aside to pay his final expenses. They pre-planned that kind of to take the burden off my brother and I, several years ago. And when I found that out, I was able to take about $6,000 of my mom's $10,000 CD and buy a $10,000 single pay whole life policy. I took about $7,000 of my dad's, bought a $10,000 paid up policy. They both had $10,000 tax-free death benefit that they could pass on to my brother and I for final expenses in that case. And I saved them a total of $7,000 between them. So keep that in mind, whether or not you're in the final expense market, work with clients that have done some planning like that or have planning set aside like that. I think I'm just trying to give you ideas on where to explore and what to look at for clients so you don't overlook that. In a rare circumstances that we do use it to reduce 1099 income exposure to any income tax on Social Security. You can also use it in a business standpoint there to reduce the tax liability that you may have on corporate retained earnings or an obligation under a non-qualified deferred comp plan or a vehicle for after-tax employee contributions. We don't see much of that. It's a really, really small piece of what we do. But I just wanted to leave that with you to say these are the places that we have found a lot of agents that's found success in how to approach clients and not to overlook any client that you've got. And whether or not we can help you make another annuity sale by presenting a Baltimore Life Generation Legacy or SPWL, and you end up selling an annuity, at least it gives you another arrow in your quiver to talk to a client about that gives them something to make a decision on, as opposed to just whether or not they want another annuity or not, or that's the best thing for them. So with that said, one of the things I Curtis got into, and I don't have as part of the slide here, but we do have our incentive trips this year from January 1st of this year to December 31st. You're right, $700,000 in single premium or generation legacy. You qualify to go for, I think it's 5 days, 6 days to Lowe's Ventana Canyon Resort in Tucson, Arizona next May. And we'd love to host you and a guest. We usually go out of the country for this to all inclusives. In fact, in the morning I leave to go to St. Martin's. The trip that we booked right prior to COVID. The reason we're in a domestic location now is that we had to book this back in the middle of COVID a couple of years ago when we first put this program together. So we think it's going to be a great conference. It's a great location for anyone that's been there and know people that's been there. We'd love to host you. So $700,000 in premium. We'd love to have you guys and some of the people from IMS as well too. So Steve Murray, I know, is gone with us on a number of occasions, but this slide here is just to say, we think enough. You are my client, IMS, and the agent are my client. Your client is the end user client. We have a client service center dedicated to servicing clients that call in with various things that they may need. And we also have an agent service center. We have a group of people that's their job is to strictly and solely man an agent service center. When you call in needing an illustration, you call in, you call into other carriers and that you may want to talk to an underwriter, and then you want to talk to a new business, and you have to call around to different departments. This agent service center, theoretically, they can help you with almost all of the cases. If they can't, then their job is to help direct that call and get you connected with the people that you need to talk to. So we think our back office service is fantastic, especially as it relates to agent services. So with that, Curtis, I'll turn it back over to you. I'm going to turn mine. If you got questions, I'll be glad to answer if you've got time for that. I know I'm right on the hour, but I wanted to finish in time. But I'm going to go on mute now, and then you guys can take it from here, Curtis.
Thank you for that, Doug. And yeah, so I think we've got a couple of questions here. And while we're talking about it, I'm gonna launch a couple of polls here while we're talking. But one of the questions that I had that came in was, generally speaking, you were showing a couple of illustrations. If a client had 250,000 in a savings account and we're dumping that in the gen leg, how does that work in proportion to the SPL? I mean, I would think, generally speaking, if you're just dumping a lump sum into the SPL, you'll get a little bit higher death benefit. But if it's the gen leg, same amount of premium, is there like a percentage difference that you typically see, or can you speak to that a little bit?
Yeah, there is a small percentage difference, and for the life of me right now as I speak, I can't tell you which one is higher. I will address why it's a little differently, and if you go back, I told you if I had some time, I would talk about the ADVRs. Because we split, and there's some other carriers out there's probably some, I think, that IMS that has a similar policy or similar concept to get qualified funds moved into life insurance. We issue two policies. We think that's the moral thing to do. We think it's the legal thing to do. And if a client, let's say a client in the 3-year example that I gave there, the client says, hey, I need to access, I need to do this. I'm going into a nursing home where I can't do 2 of 6 ADLs, which is the qualification for these, for both the ADVR benefits on both policies. On the generation legacy, it's a percent of the death benefit. So I said it's 50% for home health care, adult daycare. So let's say they can't do 2 of 6 ADLs. They got somebody coming into the home to take care of them. They advance 50% of the death benefit. And they're sitting there saying, okay, we've accessed 50% of the death benefit. Now I've got 7 more years left on my annuity payout. I want to cash in the life policy. Now I want the annuity payments to come directly to me. Because of the fact that you can split those contracts and terminate the life policy at any point in time and get the cash value out of it and continue the annuity payments directly to yourself, just like any other SPIA payment would do, it limits us on how much we can pay out on the accelerated death benefit riders on that. But you know, the 250,000 you had as an example, based off the client's age, again, it couldn't go above the 450 net amount at risk, or the death benefit for the generational legacy. So let's assume that it doesn't do that. It's going to be relatively right in line, maybe $1,000 or a couple $1,000 one way or the other. One's a little higher than the other, but it's negligible. It's really negligible. The thing you want to look at there is which one is going to help with the after-tax, or with the pre-tax types funds, where the funds come from.
Okay, perfect. Appreciate that. And then I'm going to launch our last poll of the day. And then the other question that we had was, I think some of the agents have seen that looks like that Baltimore Life's doing a pretty significant commission increase on the product as well.
Yes, we just announced that Monday of last week. You know, we always said we used to have the same level of commissions back prior to 2019. With the interest rate environment where we were at, we were probably right in the middle of a low interest rate environment at that time, and we held off. You know, this is not something, a lot of carriers get in and out of these types of products, you know, as you know, kind of quickly, and then get back into it and that kind of thing. And you know, this is one of our significant product lines, and we want to stay in it. We want to be an asset and have be a go-to for the company. And that when we said that we had to drop it due to the interest rate environment back in 2019, we dropped it significantly. We didn't want to do away with the product. We still wanted to have them available if it was a need that the client had. And we said at that time, the email that went out in 2019 said, hey, if we can increase, if the interest rates go back up, we intend to raise the comp back up proportionally. So in April of last year, I think it was April of 2020, we increased it back. We increased it up about 3%, give or take a 0.5%. I think it was. I can't remember exactly. And then we said at that time, if the interest rate environment goes up further, we will be sure to raise the comp back up. So obviously, the interest rate environment went back up on a Monday. We raised the rates actually on a Friday. We communicated it on the following Monday. So you know, we want to stay as sensitive to that as, you know, a term company might on raising and lowering the rates on term insurance business to stay competitive. We want this business. We're looking to say, okay, we want to make it we want to make it fair for the agent. We want to make it fair for the client and a good deal for the client. And we want to we only have a few number of partners such as IAMS, and we want to be able to support you guys as best we can. I hope that answered the question, Pete.
No, that absolutely does, and we're excited about that too, because you've got the same great product, but a significant increase in commission, and I think there's just a great opportunity for this type of product solution out there. So, Doug, I appreciate you taking some time with us today. For those of you on the call, I appreciate it as well. I know we went over a couple minutes, but I think you'll see, just like we do, there's just significant opportunity. So. With that, I hope everybody's good rest of the week, and we look forward to speaking with you about this. Thanks.
Thanks, guys. Thank you, Curtis.